Here's a question that sounds simple but trips up almost everyone. Two people start investing on the same day. Same amount of money, same stock market, same years of investing. One of them checks their portfolio every single day. They panic when the market drops. They celebrate when it spikes. They try to figure out the perfect moment to buy more and the right moment to pull back. The other person? They set up an automatic transfer, same amount, every single month. They don't check prices. They don't watch the news. They don't try to time anything. 10 years later, who do you think came out ahead? If you said the first person, the active one, the smart one, the one paying attention, you'd be wrong. And the reason why tells you almost everything you need to know about how wealth actually gets built. Most of us grew up with a certain idea of what a smart investor looks like. He's watching charts. He's reading reports. He's catching the market at its lowest and selling at its highest. He knows something the average person doesn't. And because of that knowledge, because of that perfect timing, he wins. This idea is everywhere. It's in movies. It's in financial news. It's in the way we talk about money at family dinners. And here's the problem. It makes investing feel like something reserved for a special kind of person. Someone with access to information you don't have. Someone with the instincts and the nerves to move fast. So what does the average person do instead? They wait. They wait for the right time. They wait until they understand the market better. They wait until things feel more stable, or until they have more money, or until the uncertainty goes away. And while they wait, nothing grows. Nothing compounds. Nothing builds. The irony is brutal. The belief that they're not ready enough to invest is exactly what keeps them from ever getting started. And meanwhile, the one strategy that actually works for most people is sitting right there, almost completely ignored. It's called dollar cost averaging. And it might be the simplest, most powerful, most psychologically underestimated wealth strategy most people have never seriously used. Let's break it down in the simplest possible way. Dollar cost averaging means this. You invest a fixed amount of money at regular intervals, say every month, regardless of what the market is doing. That's it. No guessing, no timing, no strategy meeting. You just pick an amount, pick a schedule, and you keep going. Let's say you decide to invest $100 every single month into an index fund. Some months, the market is up. Your $100 buys fewer shares because the price is higher. Some months, the market crashes. Bad news everywhere. Everyone's scared. But your $100? It buys more shares because prices are lower. Over time, something interesting happens. Because you were buying more when prices were low and less when prices were high, your average cost per share ends up lower than if you had just dumped all your money in at one random moment. You didn't need to predict anything. You didn't need to catch a bottom or avoid a peak. The strategy did it automatically, just by staying consistent. Now here's where most people tune out, because they think, okay, but what if I invested everything at the perfect time instead? Wouldn't that be better? Sure, in theory. But here's what research keeps showing us. Almost nobody actually does that successfully. Not even the professionals. Not consistently. Not over decades. One famous study looked at stock market returns over a 20-year period. It found that if you missed just the 10 best days in the market during those 20 years, 10 days out of over 7,000, your returns were cut in half. Think about that. 10 days. And you can't know in advance when those days are coming. Nobody does. That's the core problem with trying to time the market. The cost of being wrong, even once, is enormous. And dollar cost averaging sidesteps that problem entirely because you're always in the market, no matter what. But here's the deeper thing that nobody really talks about. Dollar cost averaging isn't just a financial strategy. It's a psychological one. Our brains are not wired for investing. We're wired for survival. And in survival mode, losing something feels about twice as painful as gaining the same thing feels good. Psychologists call this loss aversion, and it's one of the most well-documented quirks of human behavior. What this means in practice is that when the market drops, even slightly, most people feel a pull to do something, to sell, to stop, to protect themselves from more pain. And when the market is soaring, there's a different pull, to pour everything in right now before you miss out. This is the FOMO effect, and it's just as dangerous. Both of these impulses feel logical in the moment. They feel like smart responses to information, but they're almost always counterproductive. The person who sells during a crash locks in their losses. The person who buys everything during a bull market peak is left holding overpriced assets when the correction comes. Dollar cost averaging is the antidote to both. When you automate the process, when you commit to a fixed amount on a fixed schedule, you remove the decision from your emotional brain entirely. You're not asking yourself whether now is a good time. You already decided. The money moves automatically, and your nervous system doesn't get a vote. This sounds small, but it is genuinely one of the most powerful things you can do as an investor, because the biggest risk in investing isn't the market. It isn't inflation or volatility or even bad stocks. The biggest risk is your own behavior under pressure. Dollar cost averaging doesn't just protect you from bad markets. It protects you from yourself. So what does this actually look like in practice? First, start with an amount you won't miss. Not the amount you wish you could invest. The amount you can genuinely set aside every month without it disrupting your life. Even if that's $20. Even if it's $50. The number matters far less than the consistency. Second, automate it completely. Don't make it something you decide month to month. Set up the automatic transfer, connect it to an index fund or a diversified ETF, and let it run. Remove the decision from your hands. Third, and this is the hard part, do not touch it when the market falls. This is where dollar cost averaging actually earns its value. When prices drop and your phone is full of bad financial news, the automatic transfer still goes through. You are now buying more shares at a lower price. The fall isn't a disaster for you. It's, in a quiet and invisible way, a gift. Most people will do the opposite. They'll pause the transfers. They'll wait for things to stabilize. And in doing so, they'll miss the exact period when their money would have gone the furthest. The compounding effect of this consistency is staggering over time. Someone who invests $300 per month from age 25, averaging a modest 7% annual return, ends up with over $900,000 by age 65. Not because they were genius investors. Not because they timed anything. Just because they were consistent. For decades. Without stopping. That's the unsexy secret. The strategy isn't thrilling. There's no big moment, no clever move, no dramatic win. Just the slow, invisible accumulation of small, consistent decisions made over a very long time. And for most people, that's exactly what works. There's a quote often attributed to Warren Buffett that cuts right to the heart of this. He said the stock market is a device for transferring money from the impatient to the patient. Dollar cost averaging is patience turned into a system. It takes the most human of our financial weaknesses, our fear, our impatience, our obsession with getting the timing right, and quietly removes them from the equation. The people who never invest because they're waiting for the right moment will keep waiting. The people who invest and then panic sell when things get scary will keep cycling in and out of the market, buying high and selling low without ever quite understanding why their account never seems to grow. And the people who quietly, automatically, consistently invest a fixed amount every single month, regardless of what the market is doing, regardless of what the news says, regardless of how it feels. Those are the people who, 20 or 30 years from now, will look at their accounts and feel something that can only be described as quiet disbelief at how far it went. Not because they were smarter, not because they had more money, because they understood something simple and acted on it for a long time. The best time to start was 10 years ago. The second best time is right now, this month, with whatever amount you can actually set aside. Automatically, consistently, without waiting for the perfect moment that is never coming. Because in investing, the secret was never about finding the right moment. It was always about showing up at every moment, no matter what.